Every month, across the globe, thousands of salaries are paid out with clockwork precision. Systems hum, buttons are pressed, and billions in currency flow from corporate coffers to employee bank accounts. It is the heartbeat of the modern economy. But what if some of those heartbeats are fake? What if the names on those payslips belong to people who have never stepped foot in the building? People who don't exist. This is the ghost employee scam, a silent, invisible drain that bleeds organizations of millions year after year, hidden in plain sight within the very systems designed to manage them. In this investigation, we uncover how names on a screen become untraceable riches. This hidden scam silently drains organizations year after year. Let's go behind the ledger. To understand the scam, we first have to define the ghost. A ghost employee is a name on a payroll roster for whom no actual work is performed. They are phantoms created by those with the keys to the kingdom, HR managers, payroll clerks, or department heads. Sometimes they are former employees whose names were never removed from the system. Other times, they are entirely fabricated identities, complete with tax IDs and bank details, born from a few keystrokes. They are active in the eyes of the software, present in the digital ledger, but completely absent in reality. A name in the system, but no person in reality. This disconnection is where the fraud takes root, growing in the shadows of corporate bureaucracy. How does a ghost come to life? It starts with access. A dishonest insider with the authority to add new hires bypasses the usual verification steps. They exploit gaps in the onboarding process, perhaps during a mass hiring phase or by overriding system alerts. They enter a name, a fake address, and a social security number, often stolen or slightly altered. By the time the system saves the profile, a financial siphon has been installed. Once the record is live, it's rarely questioned. The machine sees a valid employee. The auditors see a balanced count. One entry can trigger recurring payments that last for months or even years without a single human ever meeting the new hire. The most critical part of the ghost employee scam isn't the name, it's the destination of the money. Every phantom needs a place to store their loot. Fraudsters set up dummy bank accounts, often using money mules or accounts they control directly. In more sophisticated setups, the salary is split across multiple accounts to avoid triggering large transaction alerts. The payroll system dutifully executes the transfer every month, and the money reaches its controlled destinations. To the outside observer, it looks like a standard payroll run. To the fraudster, it's a tax-free, untraceable dividend from a person who only exists as a line item in a database. Money reaches controlled destinations, leaving the company poorer and the thief richer. But what about attendance? In companies with strict no work, no pay policies, ghosts have to show up. This is where attendance manipulation comes in. The fraudster might swipe multiple ID cards at the gate or use proxy logins to create a digital trail of presence. Biometric systems are often bypassed using cloned silicon fingerprints or by simply having a supervisor manually correct the missed punches in the system later. These fake presence records provide the proof needed to justify the salary. It's a choreographed dance of data intended to fool the very controls meant to protect the organization. Systems can be fooled, and in the world of corporate fraud, perception is often more valuable than reality. Beyond just adding new names, fraudsters often hide ghosts by tweaking the master data of existing, often dormant, records. They might take an employee who recently resigned and change the bank account details to their own before the final payout. Or they might keep a deceased employee on the books, continuing to collect their pension or salary. These small edits are often overlooked during routine audits because the employee's name is familiar and has been in the system for years. It's the ultimate camouflage. Small edits, continuous payouts. By the time the discrepancy is noticed, the fraudster has often moved on, leaving behind a ghost that eventually fades into the digital noise of the company. Rarely does a ghost survive alone. This scam often involves collusion, a pact of silence between HR, payroll, and even department heads. When the person responsible for adding employees is also the one who approves the payroll and the one who checks the attendance, the controls collapse. They share the spoils, ensuring that no one asks why Rahul from accounting hasn't been seen in the cafeteria for 3 years. This internal coordination makes the fraud incredibly difficult to detect through traditional means. When controls rely only on trust, they are at their most vulnerable. In the investigative world, we call this the fraud triangle. Opportunity, pressure, and rationalization coming together to create a perfect storm. Why don't companies notice? The answer is simple: routine. In large organizations with thousands of employees, payroll becomes a mechanical process. Managers sign off on hundreds of names they don't personally know. HR assumes payroll has verified the data. Payroll assumes HR has done the vetting. This routine blindness is the fraudster's greatest ally. As months turn into years, the ghost becomes a permanent part of the landscape. They are a line item that everyone accepts without question. Routine creates blindness, and in that darkness, the scam thrives, draining the lifeblood of the company one salary at a time, until the sheer cumulative weight of the theft becomes too heavy to hide. But the ghosts are not invincible. Modern data analytics are turning the lights on. Investigators now use sophisticated software to look for patterns that the human eye misses. They search for duplicate bank accounts across different names, shared addresses, or employees with no tax deductions. They look for perfect attendance, names that never take sick leave or vacation. These digital footprints are hard to erase. Patterns eventually surface when the right questions are asked. By cross-referencing payroll data with gate access logs and social media profiles, the phantoms are forced into the light. Technology, once the tool for the crime, has now become the ultimate weapon for the investigators. When the investigation begins, the tension is palpable. It usually starts with a single red flag, a returned mail, a whistleblower's tip, or a routine internal audit that doesn't add up. Suddenly, the trusted systems are under the microscope. Auditors descend, tracing every rupee back to its source. They visit home addresses only to find empty lots or PO boxes. They call employees who don't answer. For the fraudsters, the walls start closing in. Years of fraud can collapse overnight. The shockwaves ripple through the executive floor as the realization sets in. They've been paying for shadows for a decade. The ghosts are finally being laid to rest, but the damage is already done. The financial impact of ghost employees is staggering. It's not just the direct loss of the salary, it's the lost opportunity cost, the damage to employee morale when the truth comes out, and the massive legal fees required to untangle the mess. Small monthly payments become massive losses when compounded over 5 or 10 years. For some small to mid-sized companies, a well-placed ghost can be the difference between profit and bankruptcy. But the deepest scar is the loss of trust. When an organization realizes its own people were siphoning its lifeblood, the corporate culture is poisoned. The cost of a ghost is far higher than any number on a spreadsheet could ever suggest. So, how can you spot a ghost before they vanish with the treasury? Look for the footprints. Watch for employees with no emergency contact information, or those whose addresses match a payroll clerk's. Be wary of sudden changes in bank details just before a major holiday. Ghosts always leave footprints, even if they are digital ones. Regular, unannounced physical audits, where managers have to physically hand out payslips, remain one of the most effective ways to exorcise these spirits. In the age of AI and remote work, the ghosts are getting smarter, but the fundamental red flags remain the same. Vigilance is the only true defense against the invisible thief. Prevention is always cheaper than investigation. Smart governance protects organizations by enforcing a strict segregation of duties. The person who hires must never be the person who pays. Automated alerts for master data changes, mandatory annual leave for all payroll staff, and third-party audits of the employee roster can create a firewall that ghosts cannot penetrate. It's about building a system that values verification over trust. By integrating HR and finance systems with real-time biometric data, companies can ensure that every rupee spent on a salary is an investment in a real person performing real work. In the battle against fraud, a strong control environment is the ultimate shield. As we conclude this investigation, we are left with a sobering thought. Ghost employees are not created by systems. They are created when organizations stop questioning routine. They thrive in the gaps left by complacency and the silence of those who look the other way. In every ledger, there is a story, and in every payroll, there is a responsibility. The phantoms may be invisible, but their impact is very real. The question isn't whether ghosts exist in your organization. The question is, are you brave enough to look for them? Because in the world of corporate secrets, what you don't see can definitely hurt you. Stay vigilant, stay questioning, and never let the routine blind you to the reality. If you want to uncover more corporate secrets, like, share, comment, and subscribe to Corporate Secrets.